Okay, we're going to go ahead and get started. Welcome, everybody. We are going to be talking about the cost of credit today. My name is Diana. I am a financial literacy coordinator here at the University of Nevada, Reno. And also here with me today is Conrad, and he is going to be doing the presentation. He is the graduate assistant in the financial aid office working with Nevada Money Mentors. So let's go ahead and get started.
Yeah, so like Diana said, thank you so much for joining us today. But, first things first, like who are we? Who are the Nevada Money Mentors? Firstly, we do classroom presentations, we do virtual workshops. It's kind of like what we're doing right now with you guys here. We do tabling events like Dollars and Donuts, where, if you ask a question, we give you a donut. And our main thing is one-on-one coaching. So you can actually book coaching appointments right now on our website. It'll just go directly to you can book me link, and you can just schedule a website or an appointment with us pretty easily as well. Some of the topics that we touch on, mainly budgeting, saving. If you're looking to study abroad, how do you budget and save when you do that? Looking at, building up credit, and finally paying down debt as well. Right. So what is debt? I guess in order to kind of understand, credit more, we have to know, like, what is the definition of debt? Here we have, it's an obligation that requires one party, the debtor, to pay money to another agreed upon value to another party, the creditor. So it's a deferred payment, and what that means is it's a series of payments. So it differentiates from, immediately buying something. Well, let's take a look at a credit card. I assume most of y'all have credit cards. This is kind of essentially, what it looks like if you don't know. It's a thin rectangular piece of plastic or metal, and it's issued by a bank or financial service. And it's this tool that, we might use it every day. It lets you borrow money up to a certain limit from a bank or another issuer, with this understanding that you'll pay it back as well. So when you have a credit card, you're creating debt. It can be temporary or long lasting. And what we call this type of debt is revolving debt or revolving credit. So pretty much a revolving credit is this type of credit that does not have to be a fixed number of payments, in contrast to an installment credit, which we'll dive into a little bit more in the next couple of slides. Revolving debt, usually refers to any money you owe from an account that allows you to borrow against this credit line. So you guys might remember, you have this like credit limit when you first start off with a credit card. And then finally, when we talk about like the advantages of, having a credit card, it gives you this flexibility to spend on credit month over month. And it could be beneficial. Maybe you have, cash back, so you're trying to earn rewards. As long as you're paying off that balance on time every month, it can be really beneficial to have a credit card. Let's take a look at some credit card stats. Visa is actually the most common credit card, making up 52.8% of all cards in circulation. Credit cards are used for 28% of all payments. I actually thought this number would be a bit higher. That's something Diana and I discussed. The average credit score is 714, and on average, people have 3 credit cards. So some food for thought, true or false? You can just answer in your head, think about it. You have to be 18 or older to get a credit card in your name. Yeah, so that would be true. You do have to be 18 or older to get a credit card in your name. If you're younger than 18, what would happen is you'd have to be with like a parent to kind of sign off, be authorized on that. And then looking at loans, some of the most commonly type of loans are student loans, mortgage loans, auto loans, personal loans, and peer-to-peer loans. So as we mentioned before, loans are different in terms of, they're installment loans, where there's installment debt or credit, no end date, or there is an end date. And that means that when you do have an installment loan, that means you have to regularly have regular scheduled payments or installments for that matter. Most of the installment loans are fixed rate loans, meaning the interest rate charged over the term of loan is fixed at the time of the borrowing. So you're pretty much paying the same interest rate.
Okay, so what is credit? Credit is obtaining goods or services and then paying for them at a later time under agreed upon terms. Credit cards, mortgages, car loans, things that we Conrad had just talked about, service contracts such as cable, telephone, utility service, and then even financial references. Your credit does not equal your debt, but there is a caveat to that, which I will explain a little bit later. So here's kind of the cycle of credit. So you pay the lender updates your credit record, the lender shares this record with reporting companies, and then credit reporting companies share with new lenders, which would be like new credit cards or new car loan company. So that's who the lender is. They're lending you that money. So credit report. So credit report, this is your credit file and your credit history. This includes all sorts of information, personal identification on your public records. If you have any collections are bad. Those are when you haven't paid a lot of stuff, and so then a company sends you to collections. And if they send you to collections and you have like collectors calling you regularly and contacting you and just like not leaving you alone to say, hey, you owe this money, you owe this money. There's also credit accounts that show up on your thing, and then any requested files can show up on there. You can look up your credit report for free in a few different ways, and we'll talk about that. Why should you care about your credit? So lenders are going to use your credit report and credit score to gauge your likelihood that you will pay back a loan. There's some pretty strong back statistics on this, and so again, we'll talk about that. A strong credit history enables you to obtain a credit card, home and auto loans, and many other valuable credit services that can affect the amount that you will pay for these services. Reports are also used in other non-lending situations, such as employment checks, apartment rental applications, utilities, cell phones, etc. Your credit report serves as your financial reference to companies who you want to do business with. So when you think about going to college or getting a job, and you might have a letter of reference that somebody writes based on your behalf, and that's based off of your character, well, you have a financial credit report, which is going to be your financial reference so people can see if they want to continue to do business with you. So here's where you can check your free credit report. It's annualcreditreport.com. It is free. It used to be that you could only do it once a year, but then COVID happened and they kind of opened it up. So you can kind of check it as much as you want. When you check your report like this, this annual credit report does give you a full in-depth history, and it doesn't affect your credit to do that. I'm not sure why, but if you apply for a big loan or a credit card or something like that, an auto loan, a home loan, you have what's called a hard inquiry on your credit. And that hard inquiry, if you have too many hard inquiries, usually you would only have a hard inquiry if you're trying to create some sort of a debt, trying to create access to more financial resources. And so having numerous hard credit checks on your report shows up negatively. Looks like you're really like trying to create more access to money. Now, the other thing is called a soft credit report, and some items that we don't have on here, but a lot of banks will show you your credit score, and it's a soft credit report. It doesn't really show you very much history though. And then also Credit Karma is a really common one that a lot of people use, that you can also use and put all your information, and it'll show you some basic history, and it'll give you their score. And it usually contains two of these three items, and your score can vary between Experian, Equifax, and TransUnion a little bit. It doesn't vary very much. It's just how they kind of rate or review some of your information. Okay, so how is a credit score determined? So a credit score, which I like to call how well do you manage your debt, or how well do you manage your possible debt score. So this luckily is starting to change, because it's usually only looked at on your possible debt options, such as credit cards that you have, or loans that you have in your name, whether those are student loans, a house loan, a car loan, any sort of a bank personal loan. You can get just a personal loan for personal things. What they do is they look at this. They look at the first thing is your payment history. They want to know for sure, are you making your payment on time? Like, that's the most important. Like, are you making your payment on time? If you're not making your payment on time, that's going to go down quickly. They're going to look at how much do you owe. This is 30% of how your score is determined. You generally want to owe less than 10% of your possible debt. So let's say you get a credit card and they give you $1,000 limit on it. So as a student who's in college and you don't have a lot of credit history, $1,000 is quite a bit of money. But then somebody who is like 35 and they've got good credit, they might have a house in their name and a car in their name and numerous credit cards. Like the fact that Conrad had stated in the beginning of the presentation, people have on average 3 credit cards. So maybe their total amount of debt, optional debt, or that they have owed on accounts is closer to like 50,000, not counting a house, because then it would, be hundreds of thousands. But they want to look at what the percentage of debt that's owed on that, especially those credit cards. You want to keep it below 10%. So if you have $1,000 limit available to spend, you want to have your debt to be at $100 or less on that. They're going to look at what your new credit and your length of credit history. So how long have you had your credit? And generally 6 years is what they like to see. Now, if you are within that 6 years of being 18 and you could just start getting credit in your name, it's going to take you a while to build up that credit history. And then your types of credit, the mixes. Is it just credit cards? Is that all you have? Do you have a car loan? Do you have student loans? Do you have a mortgage? So kind of look at some other things on here as well. So now let's talk about what this actually means when you get a score. So your credit score. So on here, they're looking at, if you have an excellent credit score, 781 to 850, that's very, very high. And then it kind of starts going down from there. And then these colors, these percentages, is the population. It's like, where's our population kind of split out at? Very poor is 5%. Poor is 21%. And I will say that a lot of students do pop into this poor and fair range when they first get credit. So don't let those numbers scare you, because very quickly your credit will go up once you start creating good habits, like we talked about on this previous slide, such as making payments on time and keeping your total debt low. That length of your history will immediately start accruing, and it'll start to improve your rating pretty quickly. So don't be so scared if you kind of have a poor or fair score initially. So these are where those numbers are. It ranges from 300 all the way to 850. Okay, so then let's looking at what the average score is. So we talk about, here's kind of those averages in the middle, and it also gives us an age range too. So student age, who are ages between 20 to 29, have that 660 score we talked about. 30 to 39 kind of gets up here to 673. 40 to 49, 684, and then people who are over 60 generally have a pretty high credit score of 749. Now, this does not have to be you. I can tell you that my credit score is pretty close to 800, but I've had to work really hard at it, and I'm in my 30s, so I'm not hitting the average here. But I will let you know that not very long ago, within the last 10 years, I was in this range, having some credit card debt and still in grad school, and having, not having a lot of a strong salary to pay all of my debt off all at once. And so these numbers are not, they're not going to hold true in every scenario. It is an average that we're talking about. And now I want to bring your attention down to the bullet point at the bottom. So when you are, a credit company is seeking out to give you a loan, they're going to want to see what your score is. So somebody who has a very poor credit score, that 300 to 579 range, they have determined across the country that about 62% of people in this range will default on their loan. That's a really high percentage. It's more than half. But very quickly, as you can see, if you're in the 670 to 739 range, which can be college students, only 8% default. That's 92% of people will not default. So that's a pretty high percentage there. And then if you're in the really, really high range, the excellent range, the 800 to 850, less than 1% of that population defaults. So you can kind of see an idea of how credit card companies and loan companies, how they want to give you what kind of risk they want to take by lending you money to turn around and pay back. So true or false, if you have bad credit, your lender will likely give you a lower interest rate. True or false? You can just answer to yourself, or you can either answer it yourself or you can pop it in the chat. True or false? Got one answer in there. False. That's correct. The answer is false. They are likely going to give you a higher interest rate if you have bad credit because they are taking a risk on you. And so if you are going to be making any payments at all, they want to get more money for their buck. And so what they loan you. And so they're going to charge you higher interest so that you're paying them more than what you borrowed in the hope that if you did default, they've kind of earned some of that money ahead of time, because a default means you're not paying them anymore. And so they're the ones that are stuck with having given you money and not getting that money back. But you don't want your credit to get ruined, so hopefully you make the payment. Okay, credit report versus credit score. Okay, a credit report, which we kind of talked about, it's just your history, it's your activity, it's what somebody can look at to see what's going on in your credit report and what's happened in your past. A credit score, this uses, this is kind of looks at that information from the credit report and determines your credit worthiness, ranging again from 300 to 850, and how reliable you're going to be, how responsible you will be. I have the first home that I bought before I bought a house with my husband, we decided to keep that home, and I have renters in it. And I run a credit report on people who are going to rent my home to see if they are going to be good renters. And so I don't see a credit score. The system that I use doesn't even show me a score because I don't see that super relevant. I just look at their credit report. And it just gives me some basic information on if they make their payments on time, and if they have, it also looks at criminal records to see if they ever have, defaulted or been evicted from a property. And so with that credit report, it lets me know if they have always paid their rent on time. It lets me know if they have paid their other credits and their student loans on time. And so I can see if somebody is not making their payments and they're currently like past due on a lot of accounts, then that's going to be a significant risk, because I'm like, oh, they haven't cared about these other accounts. Are they going to care about renting my place? Are they going to actually pay rent? Or am I going to be stuck paying that mortgage payment if they're not going to pay? So that's kind of what the importance of a credit report is. And then the credit score is using that information to determine a value. Okay, so bad credit history. So late and missed payments, excessive credit card use. So going back to saying where you should try to have your total available debt, which is your limit, at 10% or less of that revolving credit, the credit cards that you can continuously use regularly and keep paying off and use and pay off. You want to keep that usage really low to about below 10% of total debt. Seeking a lot of credit in a short amount of time, that's like those hard inquiries we talked about. And I saw there was a question in the comment about that. It says, how long does a hard inquiry last on your credit? And it lasts 3 years. It takes 3 years to fall off before it comes off of your credit. If you are shopping around, say you are going to buy a home, I'm going to keep answering that question for a moment, and you want to make sure you get the best rate. So you look at numerous different companies to check your credit, and they're checking your credit. If they're all done within the same amount of time, they all count as the same hard inquiry, even though they're different companies. So that doesn't hurt you if they're within the same, I think 30 days is, I think is the rule. And then that hard inquiry, the value of the information they get from that lasts for 90 days. So they don't have to check it again. If you do buy a house within that 90 days, they don't have to check it again. Now, if it takes you a lot longer to buy a home and you're not finding what you like, and then you pass that 90 days, well, then they're going to have to run that hard inquiry again. And now you're going to have another check on your credit. And then continuing on with this bad credit history, foreclosures, bankruptcies, repossessions, if your car gets repoed, if you're not paying off, charge-offs, settled accounts, all of these things show up. And so a settled account is if you don't quite follow for bankruptcy, but you work with a company and you're like, hey, I really can't afford this. I made really bad decisions. I paid too much. Or you work with a debt relief company. And so what they do is they make an agreement. They're like, okay, well, they can't afford this. So they're either going to go into default and not pay any of it at all, or let's decide on half and they can pay half of it. This really affects your credit score negatively, but at least you're not stuck out there with collections after you and with a lot of debt over your head. And so if somebody does get into a very bad situation financially, a settled account is an opportunity to start working back up as a way to start improving. The consequences of having bad credit. You have difficulty getting a loan, more likely to default, and credit cards if you have bad credit, high interest rates from loans and credit cards, paying extra fees and security deposits that aren't required of borrowers with more favorable credit, like leasing a car, renting an apartment, and then paying higher car insurance premiums when you've noticed that if your credit was better. Car insurance is unique because car insurance is one of the first companies that's really starting to show up on credit reports, because car insurance isn't a debt. It's something you're required to have by law if you have a car. And so that's actually a benefit if you are paying your car insurance regularly, and it's not a debt option. It's just looking at your payment history. And utilities in some states are starting to report on credit reports as well. And so again, that's another benefit, that it's not just about managing how well do you manage your debt or your possible debt. So it's nice to see that other things are coming into play to help students, not just students, but help people increase their credit, because there's other factors that are looked at on how somebody can manage their money, as opposed to just managing their debt. Okay, so if you do have debt, what's the best strategy for paying it off? It can be really overwhelming. These are the two most common ways to pay debt off as fast as possible. So there's a snowball method and an avalanche method. So the snowball method, if you think about making a snowman specifically, you start off with a really small snowball and you roll it and you start pushing it through the snow and pushing it and creating like a little path in the snow, and it gets bigger and bigger and bigger and bigger. So that's the concept, is you're going to make the minimum payments on all of your debt, but your smallest balance, you are going to pay a little bit extra on. Any extra that you possibly can, you're going to pay that off. That is going to make that smallest debt gone as fast as possible, because you're paying it off. Now you're going to take that minimum payment on that smallest debt, because that debt's gone, and you're going to add it to the next smallest balance. And so it's kind of creating this momentum of paying off your debt quickly. This has been proven as being the most psychologically beneficial. It prioritizes on the size of the debt first, and if you have numerous different debts, eliminating those is going to help psychologically move forward, and you're going to eliminate some of those options. So now let's look at the opposite, the avalanche debt. This focuses on your interest rate, whatever interest rate happens to be the highest. You're still making the minimum payment on all of your monthly debt, but whichever credit line has the highest interest, which is usually a credit card, that's going to get the extra little payments that you're adding until it's paid off. And then you move on to the next highest interest debt. Now, financially, this is the better option. Because you're paying less over time, because you're paying off the highest interest debt first. But if you have numerous different areas of debt, still it goes back to psychologically, more people are significantly successful doing the snowball method than the avalanche method. So even though the avalanche method is better, speaking from a financial standpoint, if you're not going to be successful at it, is it going to be worth it? If you are going to be successful with the snowball method, it's more worth it. Okay, so we're coming down to the end here. So closing thoughts. So looking for a credit card with a low annual percentage rate, that's the interest that they're charging you. Low or no annual fees when comparing credit cards. I really suggest no annual fees until you have established really good credit and you understand how annual fees work and you can understand the benefits, how a credit card can work for you. Then you can start looking at cards with annual fees, but for the most part, I tell students absolutely no annual fees. That's something that you can start looking at in another decade from now. And NerdWallet is a really great resource that you can compare credit cards based on your needs. You can really get specific on here. You can ask for which credit cards have the best rewards, which credit cards are best if you have really bad credit, which credit cards are great if you are a student, which credit cards are great if you have no credit and you literally have no credit report because you have nothing reported. They will break down all of the top credit cards and like what company they're with, what's good about them, what's bad about them. So I do highly recommend NerdWallet. Monitor your account to make your payments on time. That's really important. It's also really important to always check your account and confirm your charges because credit card theft is very common. You could use your credit card online and somewhere the account you used wasn't secure and somebody in another state was able to get that information somehow. I don't even know how that happens, but it does happen. So it's important to make sure your charges are always accurate. And if they're not accurate, you can call your credit bureau and they can fix that for you. It's important to make sure you handle all of your debt responsibly. Always pay off your credit card in full before the payment is due. That way you are not paying interest, and you are building really strong credit that way. It is a big myth that you have to carry a small balance to build credit, and that is not true. They do not look at that. They look, if your utilization is 0%, you're going to have a better credit score than somebody who's at 10% utilization. Even though 10% is still considered ideal, 0 is still better. They just want to see that you are making that payment on time every month, whatever that payment is. And it's better to start early and get prepared for those big life events that you might need to finance later on, like buying a house, because paying cash for a house is not always possible. So you'll need to finance that. So having a good credit score before you head into that is something ideal.
So that concludes today's session, but we want to drop the last installment of our summer series will be on the 28th of July. The topic will be looking at more side hustles and investing, how we can find other ways to make more money. So be sure to put this on your calendar if you're interested in this topic.
Oh, I wanted to jump back in. If anybody has any questions, there's some coming in here. So there was a question in the chat that says, does closing a credit card with a high APR hurt your credit? So that question can even just be rephrased and say, does closing a credit card hurt your credit? And it does. And this is why. Your history, your credit history is really important. And when you close a credit card, that history goes away. And so I actually still have my very first credit card that I opened up in, like, I'm going to date myself here. Some of you probably weren't even born yet, but in the 90s, I was in high school, and my mom was a co-signer on it. She's obviously not anymore, but it was like right before I turned 18. And so I still have that credit card. And so that has given me it's given me 20 years of history on my credit report. And so I don't use that credit card. I use it like once a year just so it stays open. Because if you don't use a credit card, they can close it for deactivation. Now, the interest rate on that credit card is very high, and that's one of the reasons why I don't use it, but I pay it off immediately. So I never pay them interest ever. So I use it once a year, so it stays open as an active card, and then I immediately pay it off. And so that question was really great. If you have a credit card, you can just cut it up. Just make sure that you are aware of it, so that if it ever got stolen, the numbers got stolen, not the physical card. That happens too, but you're aware of that card, and then just leave it open and just don't use it. Now, if you temporarily open a card because you need to make a big purchase and you're getting some fantastic deal, and they're like, if you open this credit card, we're going to give you 30% off, and you open that credit card and then use it for that purchase, and if you don't want to like keep track of all of it and you only have it open for like a few months, yeah, you can close it for sure. But if you've had the credit card for a while, you don't have to use it just because it has a high APR. You can just keep it open and then not use it. That also helps your utilization, because it's going to show that you have the ability. Say that credit card with a really high interest rate, say they give you a lot of opportunity to create debt. They're going to give you $5,000 limit. That's a lot of opportunity to create a lot of debt, but you don't use that credit card at all. You use a different credit card that is a benefit for students, and that credit card is only giving you $1,000 limit. Well, the total between the two is still $6,000. So that's a lot of possible debt. You don't want to create that debt. You want to keep your utilization. So you only use that other credit card that has a better interest rate to put gas in your car and buy groceries, and that's it. And then you pay it off in full every month. You're not paying any interest. You're keeping your utilization low. So that's going to help your credit tremendously. So if at all possible, don't close a credit card, but cut it up so you don't use it if it's not an ideal credit card for you. Now, if it does have an annual fee and that annual fee is high, that would be something to consider closing if that annual fee is not providing any benefit to you. If you're not getting some substantial reward or money back, and that's literally costing you money just to have the credit card, then that's not ideal, and I would close it. Are there any other questions about credit cards or loans, revolving debt, installment debt, credit score? Okay, I'll let Conrad continue. My contact information will be at the end as well, so you guys can always reach out with questions after the presentation if you need to. Conrad, are you ready for the next slide, or is this one you still on this one?
Yeah, we can go to the next slide. Yeah, we'd love to hear your feedback, whether it's how this presentation went or future topics. You can scan this QR code or just click this link as well.
We really value your feedback, so please let us know what you thought on the presentation.
And finally, just thanks so much for joining us today again. As we previously mentioned, one-on-one financial coaching appointments are available. You can email us as well as to schedule appointments, but we do have the You Can Book Me link on our website as well. And here's some of our social media at NV Money Mentors. You can check us out and follow us for the latest content and just financial literacy tips.
That is all. Thank you, everyone. We really appreciated your attendance today, and we hope you learned something.